If you are trading this war with your normal lot size, you are gambling, and the market is about to teach you an expensive lesson. During war, volatility doesn't increase slowly, it explodes. Gold moves 200 pips in minutes, oil gaps 5% overnight, USD reverses violently on headlines, and most traders don't lose because their analysis was wrong. They lose because their position size was too big for the environment they are trading. Today, I will show you how professionals adjust position sizing during war so you survive and even thrive. Now, what war does to market in terms of gold? When geopolitical tension rises, money runs to safety. Gold becomes emotional. You will see 100 to 300 pip spikes, huge wicks, fake breakouts, spread widening. Your normal 0.20 lot suddenly behaves like 1 lot. In terms of oil, which is like Brent, if oil supply routes are threatened, especially near the Strait of Hormuz, oil becomes unpredictable. It can gap overnight if you are over leveraged. That gap can skip your stop loss. USD pairs, that is, in terms of USD pairs, the US dollar becomes a safe haven. But here is the danger. Correlations changes. Euro USD drops, USD Japanese yen spikes, gold spikes, indices fall. If you are trading all of them, you are multiplying risk. The biggest mistake traders make is that they keep the same lot during war market. During normal market, they risk 1 to 2%, and in war market, they still risk the same 2%. But volatility doubled, which means we are effectively risking 4 to 5% in real volatility terms. That's how account disappears. The real professional risk model during war, we can call this the smart rise war formula. Step 1 is to cut risk in half. That is, if normal risk percentage is 1, during war it has to be 0.25 to 0.5%. That is, if your account is $5,000, you are risking 0.5%, which is $25. That is your maximum loss. Step 2, accept wider stops. If your normal stop equals 30 pips, war stop equals 70 to 100 pips. But here is the key. When stop widens, lot size shrinks. Step 3, position size formula. Lot size equals account times risk percentage divided by stop loss times pip value. This is how institutions think. Not how many loss can I afford, but how much can I lose. Let's look at it from a real world example. Let's calculate account of $10,000, risking 0.5%. Risk amount is $50. Trading Euro US dollar, stop loss equals 80 pips. That is $50 divided by 80 equals $0.625 per pip, which equals 0.06 lot. See the discipline. Even with $10,000, you are trading 0.06 lot because volatility is dangerous. The advanced war strategy is that scaling small instead of 1% at once, enter 0.2%, add 0.2%, then add final 0.1%, only if structure confirms. One trade rule during war is that you should never stack correlated trades. Gold plus USD yen plus Euro USD equals triple USD exposure. That's hidden leverage. ATR adjustment rule. If ATR doubles, cut loss size by half. Simple, powerful, and professional. The psychology of trading during war is that war market triggers FOMO, panic, revenge trading, overconfidence after spikes, small position size, keeps your brain calm, and calm traders survive. What should a trader aim to achieve during war? Your goal during war is not to double your account. It is to protect capital, stay liquid, avoid margin call, live to trade the calm markets, because after volatility peaks, there's opportunity, but only for survivors. If you survive war market with discipline, you will dominate normal markets. Cut your size, control your risk, think like institution, because smart traders don't gamble, we calculate.